We've already talked about a deferred tax liability, which arises when we recognize income for financial statement purposes before we recognize it for tax purposes, leading to a deferred tax liability, a liability for tax that will have to be paid in the future. The opposite can occur as well, wherein we recognize income for tax purposes before we recognize it for financial statement purposes, thereby resulting in a future deductible amount and a deferred tax asset. So in this video, I want to walk through how we handle that. Here's the scenario. Winnie Magazine Company receives $15,000 of payment for subscriptions in advance during 2016. The subscription revenue will be recognized equally over the next 3 years, 2017, 18, and 19, for financial accounting purposes. Remember, we recognize revenue for financial statement purposes when we meet the performance obligation. For a magazine company, that's when the magazines are actually delivered. However, for tax purposes, we'll recognize the entire $15,000 in the year of collection, which is 2016. So we've got income we're recognizing in 2016 for taxes, but we will spread over 3 years for financial statement reporting. Just to have some other income in there, we're going to assume additional income outside of that of $50,000 each year, and we're going to assume a tax rate is 40%, similar to our previous example. So here are the income assumptions for by year. Starting in 2016, you'll notice taxable income is $65,000. That's the $50,000 unrelated to this situation, plus the entire $15,000 payment for subscriptions. Then 2017, 18, and 19 is $50,000 a year for each of those years. Notice the total taxable income for the 4-year period is $215,000. And I'll come back to that in a minute. Income tax payable, which we will see on our balance sheet, this is how much we owe the IRS this year, for each of those years is calculated by taking 40% of the taxable income. So in 2016, it amounts to $26,000 because of the additional $15,000 in income, and the remaining 3 years, it amounts to $20,000, 40% of the $50,000 in income. Now, for financial income, you'll notice in 2016, all you're seeing for income is the $50,000. You're not recognizing any of the $15,000 for which you have not sent any subscription magazines out. Then over the next 3 years, you see $55,000 each year, which includes the 50 plus 1/3 of the 15,000. Now, here's the point I wanted to make. Notice that taxable income over the 4-year period and financial income over the 4-year period are exactly the same. All we're dealing with is a timing difference. When are we recognizing the income? It's not a situation wherein for taxes we're not recognizing it, and for financial income we are, or vice versa. It's a matter of when. We'll talk about this in another video wherein we'll talk about temporary versus permanent differences. Now, if you look at the income tax expense column, then similarly to the income tax payable column, your expense number is 40%, the tax rate of the financial income for that year. So in 2016, it's $20,000 based on the 50, and then in the subsequent years, it's $22,000 based on the $55,000 in income. Another thing to point out is you can also see that taxes for the 4-year period are the same under taxes and payable and expenses. Again, it is merely a timing issue, not a difference in the expense versus the payment. Okay, let's look at the calculation of the deferred tax asset. It's a similar process that we went through under the deferred tax liability. We've got the book basis of unearned revenue, which in this case is the $15,000 in subscriptions that was received. From a tax basis perspective, there is zero unearned revenue because we took the entire $15,000 into income during 2016. That leaves us with a temporary difference of $15,000, which at a tax rate of 40% is a deferred tax asset. Thank you for letting me catch my mistake. It is a deferred tax asset at the end of 2016. And then you can see I've walked through a similar alternative approach to calculating that that we used with the deferred tax liability. The future deductible amounts for each year of $5,000, deductible in the sense that they will be included in financial statement income for those 3 years, but not taxable income, at a tax rate of 40%, leaves us with a deferred tax asset recognition or reversal of $2,000 for each of the 3 years. Adding that up, we've got $6,000 at the end of 2016. Okay. Very similar approach to the deferred tax liability calculation. It's just a difference as to whether or not you're going to have a liability on your financial balance sheet or an asset. So here we are with the similar spreadsheet to what we did with the deferred tax liability, wherein we're going to calculate the expense for the year and come up with our journal entries. You'll notice that it's set up very similarly. We have a deferred tax asset at the end of the year of $6,000, which is what we calculated in the previous worksheet. At the beginning of the year, it was zero, which means there was a deferred tax expense, and notice it's a negative because it's actually a deferred tax benefit of $6,000. Then we have the amount of income tax payable. This is the amount we owe the IRS this year, and that came from our calculations under the income assumptions page. That means that for the year, our expense for the financial statements is only $20,000. Remember, we recognize less income on the financial statements than we did on the tax return. In 2017, we begin to reverse that benefit. In other words, we're going to start having to expense what we previously already paid. And so we have a deferred tax asset at the end of the year of $4,000, which is the previous $6,000 minus the amount we calculated in the previous work paper. Beginning of the year is just what we ended the last year with, and that means we're reversing $2,000. This year we only have to pay $20 because our income is less on the tax return, but our expense is going to be the sum of those two because we're having to expense more on our income statement because we're beginning to recognize those subscriptions. And then you'll notice, similarly to the deferred tax liability, that the calculations are exactly the same. And so we're paying only $20, but we're expensing $22. And from this data, we can prepare our journal entries. The originating year, we will have income tax expense of $20,000. We'll have a deferred tax asset of $6,000. This represents what we won't have to pay in the future. And then our liability, what we have to pay this year, is the $26,000. Then in the previous years, when we begin to reverse these items, we have an expense of 22. That includes the amount we have to pay as well as the current year's reversal of that benefit. The deferred tax asset will credit to reduce it by $2,000, and then we'll credit income tax payable for what we have to pay. And that entry will be the same in this scenario, at least every year, because of course we're assuming that we take those subscriptions into revenue equally over the 3-year period. Now, up to now, everything's really pretty much the same as the deferred tax liability. We have another issue. Oh, wait a minute. Before I go into that, let's look at the income statement real quickly. Again, keeping in mind that you do on the income statement have to break out the deferred portion from the current. So you can see your total income tax expense is 20 in 2016. You have to show either on the face of the income statement or in the notes what the deferred amount is and what the current amount is. Now, here's the other issue that arises with the deferred tax asset. Deferred tax liability, you're going to end up having to pay. Okay, well, that's fine. You're going to pay whether you have other income or not. This is income that you won't have recognized. It's different with the deferred tax asset, however, because if I don't have income in the future to take that $2,000 benefit against, then I'm not going to get to use it. It's not like the IRS is going to pay us back the $2,000 that we had paid in previous years. What that means is when you have a deferred tax asset, you actually have to look at the likelihood that you're going to have net income or taxable income in the future to offset that against. And if you're not, or if it appears that you're not, you're going to have to set up a valuation account. In other words, an allowance to reduce the deferred tax asset to what you think you're actually going to be able to use. This last journal entry is designed to reflect this or illustrate this. Let's say that in looking at future income, it occurs to us or appears to us that we're not going to be able to use the full $6,000. We're only going to be able to benefit from $2,000. What we are then going to have to do, this would be in 2016 when we estimate this, we're going to have to debit income tax expense for $4,000, which will offset that benefit of $6,000. We'll debit income tax expense for $4,000, and then credit an allowance to reduce the deferred tax asset to realizable value. This allowance account is a contra asset account. It works very similarly to the allowance for doubtful accounts. It will offset your deferred tax asset so that on your balance sheet, instead of seeing $6,000, you will actually see $2,000. Now, if down the road it turns out we are able to recognize the deferred tax asset, we do have the appropriate information, then we can reverse that at this time. On the other hand, if all evidence shows in 2016 that we're going to be able to use that deferred tax asset, that we will have income, then we do not have to make this valuation adjustment. But this is unique to a deferred tax asset.